I think on that note, we have Mrinal Singh, the CEO and CIO at InCred AMC, also with us to talk to us about the market texture. Mrinal, hi, good afternoon. Thank you so much for joining us. And it looks like it is going to be a special session, perhaps that all-time high level just around 10 points away. Once we cross that, what are the next levels to watch out for, and which sectors do you think will lead that?
So very interesting question and a very relevant too. I think the next leg of growth in India is clearly going to come from CAPEX-oriented investments that the economy is going to see, and the outcome would be in manufacturing output increase. So well, the sectors that we think are going to drive the next leg of growth in the context of Indian economy, and I think it should reflect on the marketplace as well, should be capital goods, building materials, things like mortgage, housing, and stuff like that. So these are places where we will naturally see volumes pick up. We will see investments, lined up, and there are early indicators in that direction which are clearly pointing of a revival of the capex theme or the capex scheme of things in the economy.
Right, Mrinal, the Shell also joining in the conversation. And over the last few weeks or months, we've actually seen a furious rally take place in the PSU names, especially in the PSU banking names. Do you think that's where the outperformance will be led by when it comes to the banking sector as a whole?
We have of late seen, after a very long pause, demand for credit. And the demand for credit, if you see, is largely coming from MSME. So the industrial credit, or the corporate credit as people normally say, I think PSU lenders are generally a large participant led by big names like SBI and PNB and BOB. So obviously the interest rate cycle is also in their favor. So, but then our inclination is more towards, and they will obviously do well as the credit growth picks up, particularly from the industrial and the corporate side. But our clear preference is towards the consumer of those credits, basically the guys or the businesses who are going to deploy their credit for some productive outcome, where we think the value addition could be significant. Our ability to understand and invest in the choices of valuation, risk reward are far more superior, widespread, and deep in that context.
Okay, so that's how the financial space is stacking up. But do you think that whatever were the concerns that were there at the start of the year with respect to war, crude prices going higher, etc., they're all over now and it's going to be a one-way rally, or do you expect the consolidation to continue?
So we are going to see a very different set of sectoral earning trends, and that will reflect on the returns that would come across. So particularly inflation, food prices, and crude. There are two aspects of inflation that matter for our domestic economy. Given the way reservoir levels are, the winter crop is going to be quite good. And crude, although has been elevated for a long period of time for a variety of reasons, war in Europe being one of them, we've seen of late, the crude prices having come down. And the outlook for food production being good, the rural economy has been dragging. I think in run-up to elections, we generally see the government's spending towards rural increase. If we see a good winter crop, I think from that angle, at least things will get sorted for better. If crude comes down, I think significant input prices and inflation could trickle down, which would do good to both interest rates, industry, as well as the headline inflation number, and things will very much be in place for a set of industries, for a set of businesses to actually progress towards a growth path that is more or less lined up in that space.
So Mrinal, since you're talking about the two factors, crude as well as rural demand, how do you think this will, this will augur for the entire auto sector? Because we have seen a massive rally already when it comes to the auto stocks. But this morning, incidentally, we had a note coming in from CLSA's Lawrence Belanco, which is suggesting to book profits when it comes to M&M and Eicher. Are you part of the camp which believes that it's time to perhaps book some profits, or are you looking at this upside rally to continue for the auto stocks?
So we would club the two-wheeler as well in that space. I think what we've seen for the last 4 quarters or so, a very diversionary trend within the consumer category, where, for example, categories or segments like ACs, phones, cars, two-wheelers, you name it, and we've seen higher ticket items show volume growth, although the overall base is small. But we've seen entry-level, volume getting stagnated. and the prices also, but the volume is very large over there. So which is a reflection of the rural economy kind of not participating in the growth and the urban economy actually growing, which is what we have largely seen in the four-wheeler high ticket SKUs. I think now it's time for the rural part of the economy to show growth. The way things are stacked up, both from the election side, from the winter crop harvest side, as well as other things. I think the rural part, and in particular auto, I would be more inclined towards ancillaries and two-wheelers, which feed into the rural scheme of things, and that is where we would deploy our investments into. And the risk reward is quite favorable in that space.
Okay, so that's as far as the auto space is concerned. But Mrinal, just before we let you go, wanted to understand how you're looking at the IT space as well. And the street is clearly divided there. On one hand, you have corrections of around 20 to 30%, which makes it attractive and gives you that FOMO perhaps that you should be looking at buying in. On the other hand, there is this worry that US is headed in a recession and the earnings estimates are not fully factoring in the slowdown that is possible. How do you see that stacking up for the IT sector?
So we'll have to take a very value conscious approach in IT. I think the swing in IT, because it's very well integrated into US scheme of things in particular, we will see overreaction by the markets. The businesses are very good cash flow generating. The quality of cash is very, very good. So for a good price, I think from an investment prism, I would pick up some select names and keep them. But I have to be very, very particular about the valuation and the price. We are not going to see the headwinds go away from IT or particularly the markets that they feed into anytime soon. Recession is a strong word. A slowdown itself can have an impact. A recession will have far more impact. But these businesses contribute in a manner and way that actually help their customers navigate through such times. So the volume demand is not going to significantly reflect the slowness or the recession trends that we are going to see in the Western world. In fact, the demand for such services where they take out cost and effectively do generate similar level of SLAs might continue on a trajectory, albeit slower than what we've seen in the recent past. So IT businesses selectively for a right risk reward, we would place in our portfolios.
All right, Mrinal, we'll leave it there. Thank you so much for joining us on the show to talk about where you see the markets headed, which sectors will outperform going ahead. That was Mrinal Singh of InCred AMC.